Markus Beran. I'm with Beran since now 6 years. Beran is an organization belonging to the German savings bank sector. So the owners are all German savings bank represented by the DSGV. We are active in predominantly in Germany, commercial real estate lending only, no private or retail business. We have selective markets abroad where we are active in Paris, also France, Benelux, and Poland, where we also have offices. But again, the main business focus is in Germany. And also one of the policies, we tend to focus on large-scale transactions to not compete with our main shareholders, but rather provide them with services and maybe some product which they can then buy from us.
Great, Matthias.
Hi, I'm Matthias Leube. I'm the CEO of Colliers Germany. Colliers is, as you will know, one of the leading real estate consultants globally. We have 7 locations in Germany, 330 people, focusing on real estate transactions in Germany, capital markets, leasing, and I'm happy to be here. Thank you.
Great, Christian.
Hi, I'm Christian Zilly. I'm the other founder of Waterway Investments, and we focus on advising clients on investing, divesting of secondary real estate, non-core real estate in Germany.
Great, and Anthony, before you say, just also thank you from us to UBS and all of your team here in Frankfurt for hosting us, which was great. Thank you.
So, Anthony Shayle. I've never got that for saying my name. So Anthony Shayle from UBS, based in London, maybe in Frankfurt soon enough. I'm responsible for real estate debt, commercial real estate debt across EMEA, ex-Switzerland. I have to say ex-Switzerland because it's so overbanked I wouldn't want to lend there. We have a real estate business which I'm part of, which in European terms is approximately $20 billion stroke euros, or slightly above that now. Obviously part of the wider global franchise, which is close on $95 billion now. The objective of my particular area is to move the business from what is currently a UK-focused activity into a pan-European activity over the coming years. Thank you.
Great, Chris.
Hi, I'm Fritz. I work for Orion. We're a pan-European private equity house. We're currently investing in our 5th fund, which is a 1.5 billion fund, and we invest in all office, retail, residential, commercial, any kind of sectors. We buy real estate through direct acquisitions, loan portfolios. So to try and get our hands on the asset, we can do that in various routes, and I look after Germany and Central Eastern Europe for Orion.
Let's just pick up, maybe starting with you, Markus. On the economy, on the macro picture, we've obviously got growth now in continental Europe, less so in the UK. And it looks as though that's stable, low interest rates environments. What's your sense of the economy and how that's going to impact on or influence real estate markets in 2018?
Well, the occupier market is one of the drivers in real estate economy, and that is stable. So will be markets throughout. So where there is demand meeting supply, this will stabilize and keep the market stable. Or where there's under demand, under supply, we will see what we see earlier, maybe some increasing rents. Seeing Berlin and area there, and generally for our outlook, that means wherever there is a transaction, we are there and happy to produce new product.
Okay, good. And Chris, for you, are you looking at, in terms of the bigger macro trends, how are you looking at the economy? And you're obviously looking across Europe as well. So how does that fit in terms of your picture of Europe, but also specifically of Germany?
First of all, I'd like to pick up on the party point. I like the analogy of the party. I think when you're at the party, you keep your eye on the champagne and you look at how much champagne is left, and everyone looks at these economic forecasts. But it's generally not the champagne running out that causes the party to end. It's some external factor that no one thought about that suddenly comes, be it a correction in the American stock market, be it something in China happens that no one was monitoring. So I think the party in itself is all fine, it's going on. the economic growth is very strong, the economic fundamentals are very strong, so there's strong occupier demand. So you can't see the champagne running out until something else has happened. It's not the champagne running out that causes the end of the party. So that's just my thought on economic predictions. So generally, we aren't macro players. We go from the property, and then we look at the surroundings. We always look at the real estate first. And if we like the fundamentals of the deal, be it the leasing risk, be it a reconversion play, we've got to like the asset, the location, and then we generally look at the fundamentals. But often we find if everyone else is looking at the same charts, it's often too late. So we try and be slightly ahead of that curve and not go just where the economics point to us. So we invested in Spain in 2011 before the wave came, and that was more based on a real estate fundamental play. We built the biggest shopping centre in Spain at that point, which was one of your deals of the decade. So it's more about the real estate. It's more about the real estate fundamentals, and then if the economics support it. Obviously, if you're looking at sub-markets, you look at that sub-market. So in Frankfurt, you could say it's now 6% vacancy, but if you look at it's more about specific sub-markets. So you'd look at Niederrad specifically and say, oh yeah, actually it makes sense investing here. This is a take-up, but we don't look at it too much on a macro level.
Okay, good. And actually, that deal which did absolutely get the editor's choice for deal of the decade in Europe. It happened to be in Spain, but fantastic early adoption, I think, and seeing a trend before others did, I think, there. I wanted to come to you, Christian, actually, just in terms of, we've been discussing political risk for the last 18 months, really, as one of the big topics. And interestingly, in the discussion with the panelists for the panel in Paris tomorrow, one of the points that they raised was that that now France is the most politically stable country in Europe. So I just thought, now that's either a very big change around in the last 12 months, but what's your view on that? What's your view in terms of Germany especially? How do you see France in comparison, and the UK, obviously, from my perspective anyway, looking a bit of a mess currently?
Well, politically speaking, we have to wait and see. If we get the grand coalition between CDU and SPD, then I don't think anybody will say that France is more stable than Germany. And then you can't forget that 35% in France voted for Le Pen. So there's a big question mark between after stability in France. We have to see what comes out of in the discussions between Ms. Merkel and Mr. Schulz. But apart from that, there were new economic figures released yesterday or a couple of days ago that the German industry will employ further 100, 200,000 people next year. The economy, as we just saw, is growing Germany. So I don't see any risk to political and economic stability in Germany. Okay, good. And Anthony, are there? We've looked at there's a lot of positive sentiment about the market. Are there risks that you think? Are there things that you think might keep you awake in 2018? Is there anything that you're particularly worried about? Not necessarily in your private life. This is just
too much drink last night. So the things that worry me in 2018, we clearly have 1 year further on from the beginning of the Brexit discussions. At the moment, we have no clarity. Will we have clarity in 3, 6, 9 months' time? It's almost impossible to tell. I think there's an awful lot of political risk in the UK at the moment. I attended the MSCI conference in Brighton last week, and there was an awful lot of discussion about the political stability of the UK government. It seems to be hanging on a bit of a knife edge. There is even suggestion that there could be a second vote on whether or not the UK should be leaving the EU. I think that's quite a long shot. I think it's very, very much a long shot. But however it pans out, there is a lot of uncertainty in the UK. We do a political or a global uncertainty chart within UBS, and the chart shows that whilst it's down from the peak of 2016 to a low level, it still stands substantially above where it has been for most of the last 30 years. So for 2018, the things that keep me awake, the big elephant in the room that nobody wants to talk about, we've seen it happen in the US, we've seen it in the UK, interest rates are rising. Will it come to the Eurozone in probably not the next year, but it's happening at some point in the near future. I think the question about the global distribution of equity capital, whether it's coming direct into real estate or it's going into funds, be they debt funds or equity real estate funds, I think that's a question to be asking, and how investors want to allocate their funds. So I think there's a lot of things that are fundamentally uncertain that do not necessarily resolve in simple economic analysis or indeed property market statistics.
Okay, good. Matthias, do you want to pick that up for Germany? Are there any particular things that you're concerned about in terms of risk? Do you think there is a contagion risk from Brexit, if you like?
I think there is not a real risk from Brexit for Germany. I think the reverse. I think there's an advantage for Germany in a sense of people and jobs moving over. I think Brexit is negative for the EU, because it brings a lot of uncertainty into the EU environment. I think in this current environment, a second vote could be possible from an outside view, and I think it would be good. I would be positive about that, because I think a second vote might not lead to a Brexit at all. But in terms of Germany, I think what we are seeing is, as outlined earlier on the research from Commerz Real, we are probably seeing a record year again, so exceeding the 55 billion transaction volumes. I think what hasn't been fully covered, I have to say, is I see it a bit different in terms of the yield gap, in terms of narrowing. Yes, this is correct, but what was different in the former years was we didn't see any kind of rental growth. So in that context, the yield gap narrowing at the moment in terms of net initial yield needs to be looked at in with the view of rental growth in the cities in Germany, which is significant, and there's a lot of fantasy from particularly international investors which take up almost more than 50% of the capital into Germany, and in that context a lot of people are interested to invest into the top 7, but also beyond the top 7 markets at this point in time.
Okay, good. I'm going to come back to capital flows and what's happening with the investors shortly. But Markus, I just wanted to pick up with you Anthony's point about interest rates. Do you see a risk of interest rate rises? And also, just looking at the prices that we were talking about here, how does that impact on loan to values? And are you having to change your strategy a little bit around lending and the risks that you take?
But the development of interest rate is difficult to predict. I mean, there's certain streams even in the ECB. Some say this quantitative easement should stop. Some say they shall continue. As long as the southern markets are not recovering to a substantial way, that will not happen, and that will lead to a longer term low interest rate. That I think is not crystal ball as what everybody kind of expects. As long as there's no exogenous shock coming to that. What do we make out of that? We see that the price is going up. We changed the analysis not only to LTVs and ICRs, but we look at square meter lending, average price per square meter. How much do we lend on that? And we look at exit yields when we grant loans. So where are we when the loan matures, and how much debt yield is then on that? So this analysis becomes way more important than the pure LTV going in. So that after low maturity, we have sufficient capability to serve a debt in prolongations.
Okay, good. And Anthony, and how does that work in terms of your fund? How do you see risk in that sense?
I think the perspective we have on interest rates is that small shifts in interest rates are relatively benign. I think once you start to move beyond 20, 25 basis point movements, that starts to have an impact on the market. It's not because necessarily the interest rate directly feeds into the real estate market, but it starts to feed through from the occupier market. And the minute that starts to hit, so occupier demand will start to slow down and potentially move into reverse. Of course, for lenders, occupier demand is everything, because that's the stability of rents, that's the stability of rental increases. So we see the interest rate environment as being obviously very sensitive to everything that we're doing. I think the perspective that most of the alternative funds have, because they are by and large fixed rate lenders, is that as interest rates rise, if they are a fixed rate with a fixed target, it means that they become, by some oddity, a more competitive play relative to banks which are variable rate lenders. So as the interest rate rises, the variable rate lender will provide an increasing cost because the margin stays relatively constant and the base goes up, which then moves it towards the fixed base of the alternative providers. So I think there's an interesting interplay between the demand for debt, the a requirement of occupiers for space, the stability of the income line, and the cost of the financing of that income line. And I think there's a very narrow window during which the interest rate environment can move before things start to change, not necessarily for the better across the market as a whole.
Maybe I can add to that. You're talking about variable lenders on variable interest rate. Well, our experience, we see that 70-75% is on fixed rate, is on long-term finance, and most of them look for 10 years money rather than 5 years money at the moment to lock in low interest rates for relatively long term. That will have an impact on new production in 5 years because there's no loan running out. So we anticipate business which is done in 5 years already today. And as I said, 75% of our loans are fixed, not floating.
So are your developments 10-year durations?
The development is a smaller part of our business, but we're talking about investment loans, which when you say alternative lenders, do they go into? You talk about coupon, is that they're fixed rate lenders, and then you must compare them to the mortgage bank or as well fixed rate lenders, which we are.
Chris, I wanted to pick up with you the point that was made there about whether or not pricing is overvalued. How difficult is it for you at the moment in the market to find value in Germany? And also, I guess, how does that compare with the other markets that you're active in Europe?
I think it depends on your approach. We have the difficulty that when we underwrite a deal, no one knows what exit yields are going to be. So as a house, our general assumption or approach is to take like a 10-year long-term exit yield, and that makes it very difficult. If you take any kind of long-term yield, be it a prime London yield or whatever yield you use, you're so much above the current yield, and to really be competitive in this market, you kind of have to assume that in 5 years' time, you'll still be able to exit at today's yield, which is a historic low yield. So that's quite an aggressive assumption to make. So for us, we like to look at investments where we can add value, increase the yield by active asset management, basically, so that we can build up a cushion from where we are today through active asset management, that we sit on something that when we're done with our business plan, we've generated a product which then has maybe a running yield of 6.5%, and then we can look at like a cash on cash where we generate a double-digit cash on cash, and then we're quite flexible. Then we don't have to sell in 5 years' time. We can sell in 7 years' time, or we can sell in 4 years' time. It doesn't really matter. So that's how we look at it, because we can't put in our investment memo, are we going to sell this building at a 3.5% exit yield, because it's not how we operate.
And in terms of capital that's coming to you, are you seeing difference in terms of the flows of capital that are coming to you, whether that's more from Asia or more from the US, or what are you seeing of people coming to you?
You mean in terms of our investor base?
Yeah.
Well, we've just, at the beginning of this year, completed our fundraising, and 80% of the investors stayed the same. So we're lucky in the sense that we've got lots of people who wanted to continue the relationship with us, and obviously they had the first call, so it hasn't changed a lot. I mean, we're still, majority is from the US. I think we're the typical kind of private equity house, European, that US endowment funds invest in to get their pan-European real estate exposure. We have sovereign wealth funds, so it's pretty global, but it's always been that way, so it hasn't changed much for us personally.
Okay, good. Maybe coming to you, Christian. Just what have you seen in terms? I know Christian has prepared a brief couple of slides about capital flows that we didn't have time to include here, but I will make sure that they're available on the website and you can all access them. But maybe just pick up a couple of those things, Christian, in terms of capital flows at the moment, and also just your kind of personal sense that you and Carsten have had really of the types of capital that are coming and looking at Germany especially.
Well, you see that once foreign investors went to London, the next stop now is basically Germany, and historically this meant US investors, the opportunity funds that everybody knows from the last cycle, etc. But nowadays the investor base, the foreign investor base, is much more diversified. It's lots of investors from South Africa, Asian investors, and this is all across the risk spectrum. You see Asian investors which buy only core investments. I mean, half the city center is now in Asian hands. But you also see new investors which have more value-add appetite and which can go to places like Eschborn, Niederrad, and Neuss, for example, New Düsseldorf, etc., with very large sums. That means they invest like 100 million or so per deal, etc., and we didn't see that before.
Okay, good. And Matthias, I know out of your sort of EMEA research, you've been doing some things on capital flows. Have you seen changes, particularly in terms of the capital flows, whether that's more Asian money coming into Europe or Germany specifically, or Middle Eastern money? What have you seen?
So basically, as I described, so we have seen about 38 billion of transactions by end of Q3 this year. We expect that transactions will be beyond 55 billion, so we will see another record year potentially this year. And how does this split up? Basically, over 50% of the money is basically coming from outside Germany. So the big driver for the pricing is coming from international investment, either direct or via investment managers, asset managers. So that's clearly a significant trend. I think what we're also seeing is that a number of investors are looking more into core. So we've seen a lot of former value-add investors that suddenly have a core plus strategy, for example. This is also something that we've seen over the last, I would say, 1 or 2 years. And clearly, as you outlined, APAC investors have increased their percentage into Germany and into Europe specifically. And we are seeing some new APAC investors coming from Japan and also Australia most recently.
Okay, good. I wanted to pick up one thing which I mentioned at the beginning, which was innovation, technology as one of the bigger themes, just while we're still looking at the kind of overarching themes, and then we'll dig down a little bit more into the sectors and maybe the locations. And this is to anybody really, is how do you see things like artificial intelligence, driverless cars, those kinds of things? I mean, a year ago maybe people were thinking, yes, but it's not going to happen soon. It's not going to really have a big impact on me. But I think that is now changing quite a lot. So what's your sense of that? And do you think, what are the impacts that you see and the influences that you see on the market?
Can I pick this up?
You can.
Well, a few years ago, the story was that basically the big tech companies from Silicon Valley would take over the car industry, the worldwide, the global car industry. And people thought that, companies like BMW, Daimler, etc., Ford, GM would be like, disrupted or like China today for building an iPhone, etc., putting together something like a car, and then Apple would, brand it as an Apple car. This didn't happen. What happened is that the car industry understood that there is a real danger from Silicon Valley, and turned the table, basically, acquired companies in the Silicon Valley, and is working with them now, integrating them and repositioning their own companies in order to fend off this danger. And so there was a great article in the NY Times a few days ago about that. Maybe we can put that link on the website, because it explains everything regarding the situation in the automotive industry. And yes, there are some three big elements which the automotive industry faces, which is autonomous driving, electrification, and sharing. And how exactly this will play out, let's see. But with regards to Germany, Germany is very much dependent on the automotive industry. It's, I think, the second most important industry in Germany. Germany is very well positioned with regards to autonomous driving, and also, I think, to sharing. Electrification, maybe a bit behind, but the two other points. So I think that if you say the automotive industry is very important to Germany, very important for the economic development, which is important for the occupier base of real estate markets, then I think, we're very well positioned for the next economic paradigm.
Okay, good. Maybe Chris, just to pick up with you, you're obviously you've been active in the retail markets. You've obviously seen that as well, with e-commerce coming in, being a disruptor to traditional retail in any event. Do you see that also happening in the office market with sort of WeWork and those kinds of things? How do you see that kind of innovation, technology side of things?
I think you can see it in the office market. You talk to large insurance companies, they're all working on new concepts of, maybe the staff have more flexible arrangements. But it's I think in Germany it's very tricky because the trade unions, the Betriebsrat, all of this is quite strong. So it takes a long time for it to be implemented. So these big corporates, they move quite slowly in terms of implementing it, but I think it's a change that it would be dangerous to ignore. From a landlord perspective, we've seen people like WeWork and these players come in, and from a landlord perspective, it's an interesting scenario if you don't have a traditional tenant. But if I have to pay 1,000 euros per square meter fit out, or 1,500 euros per square meter fit out, to a tenant who ultimately is a bad credit, in terms of it's not BMW, it's not Daimler, it's WeWork. What do you get as a guarantee? Not much. It's tricky kind of embracing that from a landlord perspective, because I don't want to put 1,500 square meters that I may get back after 5 years, but the tenant might not be there in 5 years' time. So it's tough.
You want to speak to that, Markus?
Yeah, it's risk money, and you've told earlier, if you're a first runner, you might be the winner. More times it might be too early, and then you lose out. I had an interesting thing in one of my calendars that the first product ever scanned by a laser scanner checkout was a Wrigley's Juicy Fruit in 1974. So just imagine how long it took to have these automatic checkouts here in Germany established, where other countries might run ahead or other cities might run ahead. It takes time. And also this automotive sector, whatever, it is a trend which is set. There will be some directions which might lead to the good leads. Some of them might out, as might some of the startups, but the trend is there, and you need to embrace it and need to tackle it. And either you go along and try to find your share in it, or you sit and watch, and that's the position you need to take. And either you're among the winners or the followers. That is kind of the way we do it.
Maybe I just want to pick up on WeWork and also on the new tech in automotive. So I think the new tech in automotive and sharing will basically lead to less requirements on parking, clearly. But I think there are other potential occupiers for this, in terms of logistics, or, for example, dark supermarkets, where basically you have a supermarket where you can, where they bring the stuff to your home, and this could be the place for that, for example. I think in terms of WeWork, I think they have done a great market timing because, as we have seen, 3% vacancy, and they blocked a lot of the space in the prime cities for them. So a lot of corporates already are trying to get contracts with these kind of companies to have flexibility in their portfolios. And I think that they are showing some of the landlords how to entertain tenants in buildings, and I think it's a great opportunity, and I think we will see investors and landlords picking up on that, on the services and also on the setup, and we will see new environments in office buildings to adopt on that. That's, I think, what I can see.
Okay, good. Anthony, you wanted to pick that up?
So I think the critical issue that faces the entire real estate industry, both UK and European, is the challenge that property owners have to be ready to repurpose the buildings that undergo technological change or indeed obsolescence. So we talk about driverless cars, making car parking potentially less much in demand. We talk about office buildings becoming less fixed places of occupational work and being much more frequently used as touchdown points. We talk about shopping centres becoming much less in demand and internet shopping becoming much more prevalent. The common thread amongst all of them is the challenge to find what you can do with your asset once it starts to fall out of favour. Now, that may not be this year, it may not be next year, but it certainly is in the next 5 years. We have to start thinking, as a real estate industry, what we do with assets that cease to be used in the same way that they have been for the last 20, 30, 40 years. And I think the challenge spreads across all of the alternative sectors as well, with very few exceptions. And I'm even thinking in terms of student accommodation. It is not beyond the realms of possibility that big university campuses could change their use, as suddenly the internet delivers educational programs in the home rather than having to go to a campus-based university. And suddenly student accommodation changes its position in terms of demand by students for one-year lettings.
Yeah, and again, this is a change in society itself. The owning is less important than the having available. So sharing cars, sharing flats, sharing whatever, Airbnb, it seems to be the new trend. I remember when we were young, the first thing you want to have is a car to get out somewhere, to be mobile. Today you don't want to own a car, you want to have it available. That's the trend in the sector, and this will be the same throughout, I think, the various real estate sectors, to have some stuff available to share and to provide service. You come back from a pure ownership to a service provider, and the ones who embrace that first will be the front runners for the new industries.
I have a quick question about, because like the title is Outlook 2018. We were right now discussing like all the statistics basically are fine. So from the next 3 to 5 years we have to do something. But could it be possible, is there some overriding theme that you guys on the panel think, well, this is going to be a theme for 2018, if I may ask?
Limited availability of space.
And yeah, I would also add that, I mean, everybody knows in which situation we are in. The question for the near future is, how can you invest and protect your money? Because we don't know if the interest rate environment will change, if inflation comes back, etc., if there is an exogenous shock, etc. But I would say the big question is, how can you invest? What's the strategy in order to be protected if anything happens? And I can only say, as we are focusing on non-core real estate markets, have a look on non-core real estate markets because the economics there are quite different. Those are very stable markets with low vacancy. Germany's economy, the big, hidden champions, they are not based in the big city centers. They are based in B, C, and D cities. Have a look at those markets. You can be much more protected. We see deals where you can invest and lever a bit and stay with the investment and get all your money back and a decent return on your equity without needing to sell the property.
I think 2018 will be looked back on from the future as being a year of transition. I think we've had 1, 2 or even 3 years of good, solid performance across all of the European countries, including the UK. I think we're looking into 2018 with a number of question marks. Coming back to my point on uncertainty, it will be a year of transition.
Yeah, go ahead.
Yeah. Well, we expected this in 2017 already with the political change, all elections in Holland, in France, and whatever. If you have the near outlook, why are we looking further apart? Because we don't have any clear view on the 2018. Then the same procedure as last year. Yeah, that is a bit like we see it goes on. The market remain competitive. The yield gap narrows, so there is sometimes a natural end. It cannot go to eternity. So if the yield is zero, then that's it. But in general, I agree. It's beginning to make a transition, and if you look into the future, and that's why all these topics with the cars, with service industries, and the automation, fintech, proptech. Why are we looking at it? Because we see that as the future, as the trend coming, and that is starting now.
Chris, anything for you?
I see the main theme being the same as the last 2 years, which is a limited supply of product for investment, a lot of capital looking for a home, thereby everyone moving slightly more to the periphery, slightly further up the risk curve, institutional investors going to value add, and everyone looking for that niche, looking for something which is not maybe what they initially or would ideally like to do. I think that's the kind of the theme that I'm picking up.
Okay, good. A similar question was asked actually, and we did a retail outlook at MAPIC last week or maybe 10 days ago. And one of the big themes of that was that everybody had said before that shopping centres would die, but in fact that hasn't been the case because people still like to shop, but they do want an experience, so therefore food and beverage taking over more. And also you've now got a transition of online-only stores now moving all into physical stores because they need to be able to support their brand. So you'll have different types of shopping. But one of the interesting things that came up in that conversation that hasn't come up at all in any of the others was security actually being an issue for people gathering together, because in Paris, after the terrorist attacks, actually the amount of shopping that went on the high street dropped dramatically, and the amount of shopping that went on online rose massively, just because people weren't wanting to go out into public spaces. So that's an interesting one that hasn't really cropped up, I think. But in the retail side, that was quite an interesting point, I thought. I want to dig down because there's a question that's come in here on. A lot of the focus has been on larger metropolitan areas, and you highlighted a little bit there, Christian, but in terms of the sort of type 2 cities, type 3 cities, let's have a quick look at Germany, but also whether or not there's lending on that, and also where the opportunities are both in Germany but potentially in other areas in Europe. So using the experience that you've got generally. Christian, just highlight some of the ones in Germany especially, and is it possible for people to be able to get financing for that? And where's the appetite? Are they looking at places that they've never heard of?
Yeah, sometimes they do actually. And the question regarding financing is a very good one. So yeah, I mean, we deal with properties in places like Saarbrücken, Kassel, Neuss, Neu-Isenburg, Unterschleißheim actually, and yeah, Halle, Leipzig, etc. And yeah, one big characteristic of those markets is they're stable, etc., stable occupier base, low vacancy. But we also see that banks, and that might be a question to Markus, are not that willing to give leverage on those properties. And if you say that, you know, maybe there is sort of type of bubble in core markets like Frankfurt, Munich, Berlin, etc. There is definitely no bubble in those B, C, and D cities, because often investors have to buy all cash or get extremely low leverage on those deals. And yeah, what we tell every investor who wants to join this investment game, you need to have your financing in place before looking for properties, because only those investors are getting deals at the moment that can either buy 100% equity or with a debt financing agreement already in place, where they have a debt investment program with a bank and only have to fit certain criteria and can move really, really fast.
And if you pick up the financing point, that would be interesting, I think, just in terms of the ability of people to be able to finance these types of investments, or whether you just see the liquidity in those smaller markets as less interesting as a lender.
Yeah, well, as a lender, you're coming out of a crisis, you focus on core, then you go from A, B, B, A, the typical EMEA situation, and the more developed the market comes, the more we go into the cycle, then all of a sudden locations and cities come back on the plate which were not attractive at all, because the market is either too small or they're not liquid enough. So go to cities like Neuss or Regensburg or whatever, and find an investment which brings you 30, 50 million in volume, is hardly anywhere there. So you need to either downsize your investment volume, or focus on portfolios and spread it out. And that comes back to the financing. When we start with loan volumes from 20 million onwards, those sub-markets are not attractive as long as it's not a portfolio of various assets, and we leave those markets to lenders which are locally present. Mainly our shareholders, which have all local presence. All savings banks are in every city and every town in Germany. They're keen on lending on their property market locally, and we don't tap into that to also not compete, because again, that is not a product we usually provide.
Okay, good. And Axel, maybe just coming to you in terms of some of the secondary cities, tier 2 cities. Is there anything clear that you've seen in terms of your research, or what Commerz Real are doing in terms of investment into those areas?
I think the secondary cities had been niches 5, 6, 7 years ago. They are not niches anymore. Everybody on the globe knows now Hannover, Göttingen. It's nothing new. And the problem with all these small cities, they are small. The number of product is so limited that it doesn't make sense really to scan all these cities to find the one product. It makes more sense to go to New York, Berlin and so on to find the right place. Commerz Real, yes, we are looking in these cities, and I'm as a researcher, I say, yes, let's go to Göttingen and Hannover, but the portfolio management say you are stupid. We need investments by 100 million. What can we buy in Göttingen for 100 million euro? And say, well, maybe.
Just while we're on the financing side as well, because there was a question came in, just in picking up the trends really, which was Basel IV regulation. Is that already playing a role in lending? Does anybody want to pick that up?
Yeah, every regulation on the horizon, which implemented or not yet, has an impact on lending policies. Clearly, banks have to preserve their equity, have to preserve their risk-weighted assets to comply later on with that. And EMEA moving to Frankfurt or to Paris doesn't matter. They will have a close look on it. Yeah.
Okay, good. I want to drill down a little bit into some of the sectors now. So, Chris, maybe in the sectors that you're working on, just give an outlook of how you see the potential of those. Do you see some sectors outperforming others in 2018?
I think for retail, we continue to be very, very specific in what we like and what we don't like. I think there's two things that work. On the one hand, you have the regionally dominant shopping centres where you have that kind of showroom effect, where you have the brands showcasing their products, where people want to spend time, where you have, say, 60,000 square meters plus. And then on the other hand, you've got the more convenience-based, either neighborhood shopping centres, which are food anchored, where you have a lot of your daily goods needs, or they're at transportation hubs. So they're the two things that we like. We don't like the sort of shopping centres which are caught in the middle, because I think we've seen that everywhere in Europe, be it UK, Germany, that it's the ones which don't know if they're the convenience or the big ones. They're the ones that we would kind of shy away from. And I think with offices, the B and C strategy may be fine, but if you're a value-add investor, it generally means you buy some form of vacancy, and you just don't have many fishes in those markets. So if I go to Frankfurt, I can compete. Obviously, there's lots of landlords, but I can compete for a tenant through active asset management, through having a product, making it sexy for the tenant, whereas there aren't that many tenants to catch, so it's less attractive being in a city which isn't one of the top 7 cities from that point of view. And I think for residential in Germany, I can't really comment, but it seems like you're nearing the peak of the market for residential prices, because the prices now in Frankfurt makes me feel like, oh, maybe London's not that expensive after all, So
Markus, yep.
Yep, but all that has to do with the trend of more urbanization, and the statistics show that back in 20, 30 years' time, a lot more people will live in urban environment rather than throughout. And if you're there in residential, in retail, in daily needs, and whatever, that is something which will be sustainable. Whereas if you're then out in the surroundings, there is not so much potential to maintain that levels. So that doesn't matter if it's a residential, if it's retail, if it's an office or WeWork or any kind of future working spaces there.
And what's your sense, Matthias, of the sectors? How do you see residential? How do you see logistics and especially e-commerce, I guess, here?
I mean, let's start with residential. Clearly, we have an undersupply of new build. So there's a requirement on a yearly basis of 400 apartments, 400,000 apartments every year. And currently we are seeing around 270,000 apartments being built. So clearly there's an undersupply that will continue. I think we will see further price increases, while we've seen significant price increases in the past, because there is no trend in another direction. Clearly, I think offices become even more attractive, and that's my theme for 2018 in terms of value creation. Clearly, for a number of cities, you see vacancy rates dropping significantly, and having space in CBD locations is something which is going to be very attractive. Particularly if you have flexibility that tenants either need to renegotiate their leases or will move out, and you basically can lease up the space for 20% more than earlier. I think that's interesting. I also like personally the situation that what we heard about shopping centers. I mean, a lot of people are after the dominant shopping centers and basically the food anchored shopping centers. And the thing in the middle is very interesting, because I think not a lot of investors are looking at that at the moment in terms of restructuring these shopping centers. I personally like that, because normally then there's value in it, because if everyone doesn't like it, I like it. So in that context, I think that's an opportunity for restructuring these centers. Logistics is going to be a continued trend. I think the good locations will continue to be really, really sought after, and I think price increases will continue there. So my favorite next year clearly is offices, because of the vacancy there.
Okay, good. And Christian, in terms of the investors that are coming to you, are you picking up any trends in terms of whether they're particularly looking at office, whether they're looking at hotels? What are you getting a sense of where the demand is?
Well, it's definitely offices. Because for the same reasons that Mr. Leube just said, vacancies are very small at the moment. Germany keeps growing, this translates into occupier demand, and we go for offices, and our investors go for offices too.
And does this mean that really, which we haven't especially mentioned, one of the big trends, perhaps picking up Leibe's point there, is going to be development? Or redevelopment, because it can't go on for that long without significant rent rises or potentially inflation, if you've got low unemployment and you've also then got very low vacancy rates, at some point something's got to happen with that. Either there's got to be more rebuilding or repurposing, or else rents are going to climb. So this is open to anybody really, is where do we think we are in that cycle? Do we think development is actually going to be a big play for next year?
I definitely think development stroke refurbishment is an increasing sector across Germany and the rest of Europe. I think there is quite clearly much need for an expansion of the available stock. I think some of the available stock has already fallen into early stage obsolescence and will continue to become more obsolete over the next 12 months. I think the really important trend for expansion of the market is not just simply a source of the equity for that development process, but there is a need for debt as well. And I think much of that new debt should be coming from alternative lenders, as many banks arguably are not best equipped to be taking development risk.
Generally, I think that there is too little development going on, and there are different reasons for this. Certainly, it's the rental growth is already priced in, so there's too little profit potential for developers. But I think that one of the key problems, to be German, one of the key problems is probably the general constructors. Yeah? We have only a limited amount of general construction firms, which is a big problem. Yeah? So if you ask developers that moved in from an international basis into Germany and looking at general construction costs and everything else, this was all fine in the past. But currently, in terms of the limited amount of people that effectively can construct developments, is a problem. Because we are currently seeing construction prices rising significantly. And effectively, there is a lack of resources, effective resources, to really build the stuff that should be built. And that's a key problem, looking at the vacancy rates that we have in the cities.
Okay, good. Markus, did you want to? Yeah.
I agree with that. So this is on a private basis. Try to find somebody to fix your garden leeway or whatever. These guys said, in 3 months' time maybe, and only if my Polish worker will reappear after summer break. That's really happening, and I have friends who have run construction companies having difficulties to finding people who do the actual work. That's the one thing. Coming back to repositioning and talking about our experience, we do developments. We also do repositioning if the business plan, if the location, and if the experience of the developer in there is sufficiently good for us to assess that risk. So yes, we do. It's not only alternative lenders but also normal banks do that.
Okay, good. One quick question, which is just picked up from Christina, actually, who unfortunately couldn't be here, was going to join the panel from AEW. And she is running specifically German money going outside of Germany in a retail fund. But also just in London, a lot of the deals that are being done, or a lot of the deals that are being looked at by German capital, specifically looking at the UK. Meanwhile, there's a discussion about all of the capital that was looking at the UK from overseas now heading towards Germany. So is that something that you're seeing, and does that mean that the Germans are much smarter than everybody else around the world?
I don't know. It's nothing with smart. The usual investment cycle was when people come from abroad, the first stop was London, the next stop was Paris, because there's single concentrated markets which you can understand, to have a big transparency, and so that was an easy investment. If you come to Germany, it becomes more difficult because you don't have the city. So it's more federal, it's more diverse, and you need then really to assess every market individually. What happens now is much money coming in here, and over 50% of investment is coming from international money. Those German main players, Patricia is one big example, saying, what do we do if we don't compete here? Where can we get yield outside of Germany? That doesn't mean they're more smart, but they look just for alternative investments to get higher yields.
Okay, good.
Just to add, I think on the UK, I think probably people in the UK are much more negative about their view on the market. I think currently we are seeing a number of German investors investing in London again, because they think sort of the low has been achieved, and they think that basically also with FX, this is a good play to invest currently in London.
So this is a little bit like the Dutch market was 3 years ago, where the Dutch was so miserable that it was difficult to cheer them up with anything, and yet everybody was then beginning to look at space, and they couldn't believe why. They were lost on that. Good, Doug, because you're here, and because you've also been, you've moved from being in the real estate space to being in the real asset space. I just wondered if there's anything that you've heard from today that also fits with what's happening in the other real asset space. Is real estate different, or is how does that work?
Well, first, thank you for giving me the opportunity. I would have to say there isn't much difference. People are chasing yield, and my investors are looking across the real assets for sustainable yield and cash. If you think my investors are insurance companies and pension funds, they have the solvency issues to think about, they have sustainable returns, and therefore they're looking at a pooled basis of real assets. Real estate is not by itself anymore. It's in competition. And if I go and talk to the CIOs, they look across the whole of the real asset spectrum. If you look in renewables, they're getting a 6% net. In aviation, they're getting between a 5.5 to 6. On the core, on the value add, they're getting over 10 net, with gearing below 70%. So real estate is in competition from a capital allocation perspective. I think some of the fundamental points which the panel have raised are very important, but one thing I think you haven't touched on yet is demography and the aging population. If there's one area of real estate which in this country will do really well, is healthcare. In the nursing home and the medical office buildings, and no one in the core real estate classes think through that properly, I believe.
Okay, good. Interesting that in the US, before there was a whole section, a huge number of listed real estate companies and funds specifically looking at residential, and couldn't understand why there wasn't the same kind of structure here. Now there is, to a certain extent. The residential has become, very much part of that as a sector. Others that are seen still as alternatives, like healthcare in the US, are not, like student housing are not. What's your sense of that? Do you think in Europe that, I guess, these alternatives are a show that the market is too frothy, that there's, that we've gone too far and people are having to seek these alternative assets? Or do you think, a bit more like Doug is saying there, that actually, like the US perhaps, it's a sign of a more mature market, and that healthcare and those kinds of things are real estate assets in exactly the same way as hotels and that kind of thing? Anybody can pick that up.
I actually agree with Doug entirely, and I think Doug makes a couple of very interesting comments. And I want to just unbundle them, in fact. I think the first point about where real estate fits in a spectrum of asset classes that CIOs would want to allocate to is really critical. From a debt perspective, the real estate debt world fits in a new category of multi-asset debt provision. So that's infrastructure, aviation, shipping, and real estate, not just the real estate world itself. I think the second point that Doug makes about alternative asset classes is absolutely crucial. We have a very large real estate debt fund and a very large real estate business in the US, and it extends its activity substantially into the alternative asset classes. About 2/3 of our debt fund, which is well over $3 billion, is devoted to multifamily or private rented sector, whatever you like to call that. From our perspective, we have been avid devotees of alternative sectors, data centres, hotels, student accommodation, care homes, residential, both for the UK and our perspective across the whole of Europe. And I think critically, the search for yield has been part of that demand for alternative asset classes. But I think there's also another factor which goes into that, which is there's been a great professionalisation of many of the operators in those sectors, and those are the ones which we're very keen to follow. Some have come from the UK, a great number have come from the US, and there are some which are emerging from Europe. But I do think the professionalisation of much of the alternative asset class space is something that we are keen to follow.
Okay, good. Did anyone else want to pick up those?
I think from our point of view, the alternative sector is much more of a opco play than a propco play. So for us, being a real estate investor, it's what we like about buying an office building in Neuss, for example. I can buy it way below construction cost. I know there won't be any more supply of it because I'm buying something at a fundamentally very good price per square meter. Once you get into the operating businesses, you're really investing in the opco and in the cash flow it's generating, and it becomes much more of a business cash flow play, and you're having to understand the business much more than you're having to understand the real estate. So for us, that's not a sector that we're playing in or contemplating playing in because of that reason.
So if it was Dragon's Den, you would be out. That would be it.
Correct, yeah.
Yeah, we see it similar from the operation point. This is a management intense. There's operational risk that usually is a corporate business rather than real estate from our perspective. Nevertheless, if you look at that, US is far advanced in that. Look at the demographics. Germany, there is a strong hint, but look also at the philosophy of people that tend to stay in their homes until they're carried out rather than being placed somewhere with others, and that they need to start to embrace and start doing before the sector really picks up. And then piece by piece, one of those assets usually is too small. If you don't have a portfolio of that, one of those care homes is 5 million, 6 million, I don't know. That as a single investment is for much of the investors simply too small to do at a one-off basis. So then they look really into operations, follow those market leaders, and tap into portfolios if you make an investment.
I've got one kind of last question, which is just designed to give everybody something to take away, which is if you had the capital, which I'm sure you do have anyway, to invest, where would you be investing now? You can either choose a pan-European approach or you can choose a German approach, whichever you want to do in terms of geography. But where would you invest in 2018?
Yeah, as I said earlier, those who will make the market in future are those who provide more than just space, but services. And that may be in the logistics last mile, that may be in office, which provides more than just space, but also internet access, whatever. This WeWork is a perfect example for it. So these type of assets is something which, in my view, have a future.
Okay, good. Matthias?
Yeah, I would invest in offices. Frankfurt certainly is top of my rank because I think still Frankfurt is a bit undervalued, from the last couple of years. But certainly offices and ideally developments in the top 7 cities.
Okay, good news for you, Olaf, there for Frankfurt. Christian?
I would also go for offices. If you look at replacement values, capital values per square meter, if you go to Frankfurt, I would also go to the submarkets in cluster areas like here, Rhine-Neckar region, etc., Rhine-Main region. That's where the economic development is happening in Germany, Rhine-Ruhr, etc. If you go to those locations, look for offices, you get great value per square meter. Can put a lot of money there.
Okay, good. Anthony?
So I'll take it in 2 parts. The first is on the lending side. For me, it's pan-European. For sectors, whilst I'm interested in lending in traditional sectors, I'm a very keen lender, despite the comments on operational risk. Done that for many years. Very happy to lend across alternatives. I think that's a very key part of the future lending market, and I think development and refurbishment are key parts of my prospective strategies. I think from the second aspect, which is where money should be coming from, I would appeal to all allocators of capital. Look carefully at allocating to debt funds, not because I'm a debt fund operator, but because it provides very strong diversification from real estate risk, getting some real estate exposure, and for fixed income investors, it provides an outperformance over straight corporate bonds. And I think for asset allocators, looking at the real estate debt space is one that can provide them with a very attractive set of alternatives.
Okay, good. Chris?
I think I quite like the retail sector, a bit like the gentleman from Colliers said, when a lot of people don't like something, it's generally a good time to look at it. And we're seeing that, especially US-backed funds, when they bring something to investment committee and it has retail on it, the US investment committee in New York might just say, "Ooh, retail, oh, we don't like it." So it's the opportunity might be there that retail gets just brushed with the general, oh, it's internet retailing, and then there might be the opportunity to go very selectively and pick things up. So I think the retail might be oversold, not only in Germany, but also especially in the UK, where you have this whole Brexit issue, where people don't know, oh, will consumers keep spending, and UK institutions are very negative. So I think retail, with the internet background and specifically as a pan-European fund, I think we're keeping an eye on the UK as well.
Okay, great, good, thank you.